All right, let's dive in. Today, we're going to unpack a really powerful investment thesis for the next few years. It's called the Trust Barbell, and it's all built on these two massive forces that are just totally reshaping the markets. One is the incredible power of momentum, and the other is a deep, structural shift called trust migration. Let's get into it.
So let's just kick things off with a pretty big question. Are the old rules of investing completely broken? Is everything we thought we knew about building a portfolio just wrong now? For decades, we've had this specific playbook we followed. But if you're really looking at the markets today, you can just feel it. Something profound has shifted.
Yeah, that old logic, the stuff they teach you in Finance 101, it's just not holding up anymore. The classic idea was so simple. Assets like stocks and gold move in opposite directions. One zigs, the other zags, and boom, you have a balanced portfolio. But that's just not what's happening. The game has a completely new set of rules.
See, the market isn't playing by those old relationships anymore. Not at all. Instead, there are these two new, incredibly powerful structural forces that have basically taken over and are rewriting the entire investment playbook. And if you really want to understand where capital is going to flow in the years ahead, you have to understand them.
Okay, so let's meet the two main characters in this whole story. On one side, we have momentum, and on the other, this really fascinating concept we're calling trust migration. And look, these are not just some fancy buzzwords. They represent fundamental, global-scale shifts in how money is behaving.
And these two forces, they kind of pull in opposite directions. Momentum is pretty simple. Money flows to whatever's already winning. It's the classic winners keep winning idea, creating these self-reinforcing trends. But then you have trust migration, and that's capital running away from assets that rely on faith in institutions, currencies, governments, and it's running towards hard, neutral assets for protection. One is about chasing returns, the other is all about protecting wealth.
Let's break down momentum first. At its core, it's almost like a law of physics for markets. An asset in motion tends to stay in motion. It's a strategy that's all about betting on the continuation of existing trends, whether we're talking about AI stocks or commodities or even currencies. It's really less about, is this cheap, and way more about, where is the money flowing, and how powerful is the story?
So why is this so incredibly dominant right now? Well, it is not just some passing fad, it's structural, it's baked into the system. First, you've got these massive passive flows and trading algorithms that are literally programmed to buy what's going up, which just throws fuel on the fire. Second, let's be honest, we're in a narrative-driven market. A big story like AI comes along, and it creates this huge wave that investors just pile into. And finally, capital is getting really picky. It's not spreading out evenly, it's concentrating into just a handful of clear, obvious winners.
Now, on to our second force, trust migration. And honestly, this might be the single biggest macro shift happening in this decade. It is the movement of capital away from things that depend on you having faith in an institution, think government bonds, think fiat currencies, and into assets that are neutral, that stand on their own. And the prime example of this, of course, is gold.
And this is not just some abstract theory. You can literally see it happening right now. Central banks all over the world are buying gold at historic rates to get away from the US dollar. Governments are racking up incredible amounts of debt, which naturally weakens people's faith in their currencies. And with all the geopolitical fragmentation going on, holding a neutral asset that nobody can sanction or freeze, well, that's looking incredibly attractive.
Okay, so we've got these two powerful and seemingly separate forces, right? Momentum and trust. One feels like offense, the other feels like defense. But here is where the story takes a really fascinating turn. These two forces are starting to converge, and they're doing it in a very, very unexpected place.
For as long as most of us have been investing, gold has had a very clear job description in a portfolio. It was your insurance policy. When stocks were crashing or inflation was spiking, you owned gold. It was a simple defensive hedge. That's it.
But that role has already evolved. Because of this whole trust migration theme, gold isn't just a hedge anymore. It has become a primary neutral reserve asset. It's now a core holding for anyone who's concerned about the long-term stability of the financial system.
But that's not even the end of the story. There is a crucial twist here that changes literally everything. And here it is. This is the core insight of this entire thesis. Gold has also become a momentum asset. The very same trend-following algorithms that are chasing AI stocks are now chasing gold. This is the hidden connection. The two great forces of our time have converged on a single asset. So what do you do in a world where your safe haven asset is also behaving like a high-flying growth stock? You can't use the old playbook, you need a new one.
And that new playbook is exactly what we're calling the 2026 barbell strategy.
Here's what it looks like. It's a barbell, weighted at the two extremes. On one side, you have a pretty significant allocation. We're talking 40 to 50% to those momentum growth assets, so you can capture those powerful trends. On the other side, you've got a heavy 20 to 30% allocation to trust and hard assets, with gold as the absolute core. And then the middle is just filled out with some private markets and a bit of cash for flexibility.
And what's really cool is this isn't a static set it and forget it strategy. Think of it more like a dial that you can adjust. If we're in a full-blown trust crisis, you dial up that gold allocation. In a crazy liquidity boom, you dial up the momentum stocks. The base case sits somewhere in the middle, but the key is that gold is a permanent reserve now. Its allocation never goes to zero.
Okay, so that's the theory. But how do we actually translate this strategy into real-world investments? What's in and what's out? Well, this is our conviction map.
Under high conviction, you can see the core themes playing out. Gold and monetary metals, obviously, AI infrastructure, energy and commodities, and high-growth regions like India and the Gulf countries. In the selective bucket, you've got leaders like the big U.S. tech names. But just as important, look at what's underweight: long-duration government bonds, broad European stocks. Capital is actively avoiding assets that don't have a strong narrative or are tied to institutional fragility.
Okay, let's just zoom out for a second here. We talked about assets and allocations, but what does this all really signify on a much deeper level? Because this isn't just about portfolio construction, it's about a profound, fundamental shift in investor psychology.
The entire investment framework has flipped on its head. The old rule was simple. Gold rises when equities fall. A simple hedge. But the new rule is totally different. Gold rises when trust falls, and equities rise when liquidity rises. And because those two things can happen completely independently of each other, it means both assets can rise at the same time. This is a complete game changer.
And this gets to the absolute core of the psychological shift. The old belief in mean reversion, the idea that things always return back to their average, is fading fast. It's being replaced by a new belief in two things: trend persistence, which is powered by momentum, and hard asset protection, which is driven by this erosion of trust.
And that leaves us with a final, really provocative question to think about. This entire thesis is really about a massive transfer of faith, away from the systems, the currencies, the institutions that have anchored the world for decades, and toward tangible, neutral assets. So what really happens to our markets when faith in the system is replaced by faith in the assets themselves? That right there is the defining question for 2026 and beyond.